investment management investment management by insurers. Risk management in insurance companies face major risk related to underwriting, claims, investments, and asset management. Effective management of underwriting and investment risk is essential for maintaining solvency, profitability, and policyholder protections. Risk management in insurance, we will discuss in these sessions about introductions, definition of risk and uncertainty, importance of risk management in financial systems, role of insurance as a risk transfer mechanism, historical evaluations of insurance and risk management, fundamental of risk, that is types of risk that we have already seen, that is pure risk versus speculative risk, categories, financial, operational, strategy, compliance, reputational, risk management, probability, frequency, severity, tools, risk matrix, expected tool models, principle of insurance, concept of pooling risk, law of large numbers, indemnity principle, utmost good faith, insurable interest, subrogations and contributions, risk identifications, risk assessment and measurement, risk control strategies, insurance risk management framework, underwriting risk, and claim and investment. Okay, let's discuss enterprise risk management. Background and use. Encouraged by the success of financial risk management, some large organizations took the next logical steps. Enterprise risk management is a comprehensive risk management program that address an organization's pure risk, speculative risk, strategic risk, and operational risk. Pure and speculative risk were defined previously. Strategic risk refers to uncertainty regarding an organization's goal and objective and the organization's strength, weaknesses, opportunities, and threats that it sought. SWOT, SWOT analysis. Operational risk develop out of business operations, including the manufacturing and distribution of products and providing services to customers by packaging all of these risks in a single risk management program. The organizations offset one risk against another and in the process reduces its overall risk. As long as the risk combined are not perfectly and positively correlated, the combination of loss exposures reduces risk. Indeed, if some of the risks are negatively correlated, risk can be reduced significantly. Many examples of such combinations of risk could be cited. Considered a simple illustrations, a petroleum company that owns and operates a refinery and service stations. Assume the business also sells heating oil to business and residential customers. During summer month, the company may agree to deliver heating oil to customers in the fall at a specified price. Between summer and the delivery date, the price of heating oil may increase. Considering this risk in isolations and assuming the company lacks sufficient storage, the company may be hitting oil futures contracts to hedge the company's price risk. However, recall that the company also has service stations which provide a natural hedge positions. If the price of fuel increases in the summer months, the company will make money on its service station. operations but lose money covering the promised heating oil delivery. Likewise, if the price of heating oil and gasoline decreases between the summer and fall, the company will make money delivering the fuel oil at a price higher than the market price at a time when service stations operations may not be profitable. To what extent have large business adopted enterprise risk management programs? Each year, the Risk Management Society (RIMS) and the world's largest insurance broker Marsh published the Excellence in Risk Management report. The report provides result of survey of risk management professionals concerning current issues and practices. The survey found that in 2010, 80% of the respondents have developed or were in the process of developing an enterprise risk management program. 17% of the respondents said either their ERM program was fully integrated and addressed risk all across the organization. Organizations also adopt ERM for several reasons. Among the reasons often cited are holistic treatment of risk facing the organization's competitive advantage, positive impact on revenues, or reductions in earning volatility, and compliance with corporate governance guidelines. Reasons cited in an earlier RIMS March survey for not adopting an ERM program include not a priority risk is managed at the operational or functional level. Senior management does not see the need, lack of personal resources, and lack of demonstrated value. The value proposition for ERM is interesting for smaller organizations and organizations with a limited fundamental financial exposure. An ERM program may not make sense. A recent study examining ERM adoptions by insurance companies found that ERM adoption enhanced the firm's value with a premium of about 20%. The most recent Excellence in Risk Management report compared the views of C-suite respondents, chief executive offices, chief financial officers, etc., with the views of risk managers. The result of the study were interesting and a gap in expectation was directed when asked about the primary focus area for developing risk management capabilities. C-suite respondents stressed the importance of strategic thinking rather than strengthening enterprise risk management capabilities. Given the ERM adoptions rate reported earlier for these large firms, it appears that C-suite respondents take ERM expertise as somewhat of a given. In contrast, risk management respondents had a narrower focus, emphasizing integrating risk management with operations and focusing more on short-term activities rather than the broader strategic view. Now, you have allotted a few topics of your risk project. Means you have to do a research, and for that you have to make a survey of the people. Okay, you are just doing this research only for academic purpose, but actually you should have to be serious about this research, and you must have to study all the aspect of that research. Okay, to qualify that research paper in different journals or acceptance by the companies. Means your research may be genuine, unique. And what was the purpose of this research? The purpose of this research is to find out the gap in the society, means which information needed by the society but not available in the society. Okay, so we have also arranged a Jellic Night 2026 for that, and you can participate in that competition. It is summer internship research competition. The presence of an ERM program does not guarantee that an organization will be successful. A survey of executives of 316 financial services executives prior to the financial crisis revealed that 18% of the respondents had well formulated and fully implemented ERM program, and 71% had an ERM strategy that was in the implementation stage. Even with the enterprise risk management program in place and chief risk officer, insurers American International Group AIG needed a federal government bailout to prevent the company from becoming insolvent. AIG's, means American International Group, near demise was caused by loan guarantees called credit default swaps issued by its financial products division. Emerging risk. As noted, ERM programs are designed to address all of the risks faced by the organizations to emerging risks that merit additional discussions, and terrorism related losses and losses attributable to climate change. First is terrorism risk. While the terrorist attacks on 9 November served as a wake up call to many. The risk of terrorism is not new. The World Trade Center was attacked previously in 1993, and the Murrah Federal Building in Oklahoma City was attacked in 1995. Foreign and domestic terrorists can attack property directly through bombs and other explosive, or they can stage a cyber attack on an organization's sensitivity data. For example, bank records, credit card numbers, and social security numbers, or introduce a virus into the computer systems. Another risk from terrorist is a CRBN attack, use of chemicals, radioactive materials, biological materials, and nuclear material. So its abbreviation is CRBN, means chemical, C for chemicals, R for radioactive materials, B for biological material, and N for nuclear material. An example of a chemical attack would be the release of a lethal gas such as sarin. Radioactive material would be released in a radiological attacks. Terrorists could release a contagious disease or anthrax spores in a biological attack. And the COVID-19 is also called as a biological attack, that the intention of that COVID is to distribute diseases in different companies. Nuclear material could also be used by terrorists. This material could be used with conventional explosive in an attack. For example, a dirty bomb combines explosive with radiological materials. The result of such an attack could be devastating. The risk of terrorism can be addressed through risk control and insurance. Numerous risk control measures can be destroyed. For example, physical barriers may be erected to prevent suicide bombers from using a vehicle to reach a building. Screening devices can check for metal weapons and also test air samples or to see if explosives are present. Computer networks can be protected by implementable firewalls to prevent a cyber attack. We have discussed about internal and external firewalls, means software firewall and hardware firewall. Software firewall is exist in computer and hardware firewall is external part. Key company personnel can be instructed on how to reduce the probability of being kidnapped by terrorists. Prior to the 9 upon 11 attacks, terrorist and exclusions were not common in commercial insurance policies. After the 9/11 attacks, insurers began to exclude losses attributable to terrorism. Okay, means few of the company avoided this clause to repay the amount of terrorism attack. Congress passed the Terrorism Risk Insurance Act (TRIA) in 2002 to create a federal backstop for terrorism claims. This act was extended in 2005 and again in 2007 through the Terrorism Risk Insurance Program Reauthorization Act TRIPRA. TRIPRA. Terrorism insurance oversight is available through standard insurance policies or through separate stand-alone coverage. Organizations with the greatest exposure, for example, large metropolitan offices building, defense contractors, port, etc., often purchase coverage for terrorism losses. Insurance underwriting has evolved to consider the terrorism risk. For example, workers' compensations underwriters considered when employees are concentrated at one location or geographically dispersed. Second, climate change risk. Losses attributable to natural catastrophes have increased significantly in recent years. Such losses includes earthquakes, hurricanes, tsunamis, typhoons, drought floods, and tornadoes. Many of these losses are attributed to the changing climate, which in turn may be attributable to carbon emissions. Greater volatility in weather patterns has occurred in recent years. Wider temperature ranges, drought floods, and an increase in a frequency and severity of storms. The increased losses when storms occur are also related to demographic factors. For example, much of the population growth in the US is in areas that are exposed to greater risk from hurricanes because American destroyed all the hill area and make the surface flat. So they are facing the greater risk from hurricanes. For example, coastal Florida, Texas, and South Carolina means every availability of natural resources is always for to maintain the security of human being. Government insurers and business have all responded to this increased risk. Governments have sought to reduce carbon emissions by restricting the amount of carbon dioxide released by businesses. Several carbon trading markets developed through which companies that are below their emissions limits can sell credits to companies above the standard. Other governmental approaches to dealing with climate change are tougher zoning and building code requirements for structural in areas where the hazard is greater. Insurers have also responded by providing discounts for energy efficient green buildings and premium credits for structures with superior loss control. Business must be careful about where they locate structures, risk control measures deployed, and in procuring the appropriate insurance coverage. Given the increased risk, businesses may also employ weather derivatives discussed later in this session to address climate change risk. Insurance market dynamics. In this session, we discussed the various methods of dealing with risk when property and liability loss exposures are not eliminated through risk avoidance. Losses that occur must be financed in some way. The risk manager must choose between two methods of funding losses: risk retention and risk transfer. Retainer losses can be paid out of current earnings from loss reserves by borrowing or through a captive insurance company. Risk transfer shifts the burden of paying for losses to another party, most often a property and liability insurance company. Decisions about whether to retain risk or to transfer them are influenced by conditions in the insurance marketplace. Three important factors influencing the insurance market are the underwriting risk, management of underwriting risk, meaning of underwriting risk. Underwriting risk is the risk that premiums collected are insufficient to cover claims and expenses. Actual loss experience differ from expected loss. Poor risk selections leads to higher claim ratios. It arises from uncertainties in frequency of claims, severity of claims, policyholder behavior. The possibility that premiums collected are insufficient to cover claims due to inaccurate risk assessment or unforeseen events causes underestimating frequency, severity of claims, adverse selection catastrophic events, natural disaster, pandemics, elements of underwriting, risk management, risk assessment, evaluate applicants' risk profile using actuarial data, credit scoring, and predictive analytics, underwriting standards, establish clear guidelines for risk acceptance, exclusions, and pricing, portfolio diversifications, avoid concentration in one type of risk or geography, reinsurance, transfer part of the risk to insurers to stabilize results, reservings, maintain adequate technical reserves to cover unexpected claim, For many years, a cyclical pattern has been observed in a number of underwriting results and profitability measures in the property and liability insurance industry. This cyclical pattern in underwriting stringency, premium levels, and profitability is referred to as the underwriting cycle. Property and liability insurance market fluctuate between periods of tight underwriting standards and high premiums called a hard insurance market and periods of loose underwriting standards and low premiums called a soft insurance market. A number of measures can be used to ascertain the status of the underwriting cycle at any point in time. It shows the the property and liability insurance industry over time. The combined ratio is the ratio of paid losses and loss adjustment expenses plus underwriting expenses to premiums. If the combined ratio is greater than 1 or 10%, underwriting operations are unprofitable. For example, the combined ratio of 107 for 2002 indicates that for every dollar one that insurers collected in premium, they do- paid out dollar 1.07 in claims and expenses means 0.70 paisa extra they have to pay. If the combined ratio is less than 1 or 10%, insurance companies are making money on underwriting operations. The combined ratio 2.5 in 2006 indicates a 7.5% underwriting profit per dollar of premium collected. Risk managers must consider current premium rates and underwriting standard when making their retentions and transfer decisions when the market is stopped. Insurance can be purchased at favorable terms. For example, lower premiums, broader coverage, removal of exclusions. In a hard market, more retention is used because some insurance coverages are limited in availability or may not be affordable. The continued stock market of the late 1990s, for example, led some risk manager to purchase multiple year insurance contracts in an effort to lock in favorable terms. What causes these price fluctuations in property and liability insurance market? Although a number of explanations have been offered, two obvious factors and liability insurance pricing and underwriting decisions that are first insurance industry capacity and second investment returns. First, insurance industry capacity. In the insurance industry capacity refers to the relative level of surplus. Surplus is the difference between an insurer's asset and its liability. Means the how he sold on what cost the policy he sold and how much amount that he has to pay against the policy as a claim. When the property and casualty insurance industry is in a strong surplus positions, insurers can reduce premiums and loosen underwriting standards because They have a cushion to draw on if underwriting results prove unfavorable. Of financial capital and the competitive nature of the insurance industry. Other insurance often follow suit if one insurance take this step. As competition intensifies, premiums are reduced further and underwriting standards are applied less stringently. Underwriting losses begin to mount for insurers because inadequate premiums have been charged. Underwriting losses reduce insurers' surplus, and at some point, premiums must be raised and underwriting standards tightened to restore the depleted surplus. What's happened if a company has taken insurance policy, okay, and few of them just paid only one installment of premium, okay, just like for 1 lakh insurance, one insurance policy holder paid 5,000 for first year and others deposited near about 10 lakhs. Okay. If there is a accident occurs in this policyholder's life and he dead, after his death, insurance company has to pay the amount 1 lakh for natural death. That is sum assured. But the company collected premium of 10 lakhs. So he will be not in loss positions because he has already 9 lakh plus amount. Okay. But he has lost in only the policy of a person that he has or she has paid only 5,000 and paid 95,000 rupees extra. These actions will lead to return to profitable underwriting, which helps to replenish the surplus. When adequate surplus is restored, insurers once again are able to reduce premiums and loosen underwriting standards, causing the cycle to repeat. External factors such as earthquakes, hurricanes, and large liability awards may increase the level of claims, reducing surplus. The insurance market was hardening when the 9/11 terrorist attack occurred in 2001. Insured losses from the destruction of the World Trade Center and other buildings by terrorists totaled amount $32.5 billion. 40 billion in 2010 dollars. The 9/11 attacks produced a what in the insurance industry is called a clash loss because insurance company had paid huge amount as a claim in this incidence of World Trade Organization. A clash loss occurs when several lines of insurance simultaneously experience large losses. The terrorist attacks created large losses for life insurers, health insurers, and property and liability insurers. A second major recent shock to insurance industry capacity resulted from claims related to Hurricane Katrina. In 2005, insured losses from Hurricane Katrina totaled dollar 45 billion in 2010 dollar. You may know about the amount of dollar million and billion, billion and trillion. The US property and casualty insurance industry sustained a loss of over $13 million in 2001, and industry surplus declined by 8.5% that year. Combined ratios of 115.7 in 2001 and 107.2 in 2002 forced insurers to tighten underwriting standards and raise premiums, causing surplus to grow. Even with claims from Hurricane Katrina and other hurricanes, the industry posted a profit and 8.8% growth in surplus in 2005. What idea that company developed, that they have covered these types of disaster management insurance with extra premium. Okay, if someone have to cover these types of disasters, natural disasters, insurance prices in general started to decline in 2006. Insurers posted record underwriting profits in 2006 and 2007. The combined ratios of 92.4 in 2006 produced an underwriting profit of $31.1 billion. The combined ratio of 95.5 in 2007 produced an underwriting profit of $19 billion. These favorable underwriting results combined with strong investment income created a record industry surplus. Surplus grew by 15% in 2006 and 6.8% in 2007, reaching a total of over $537 billion at year end 2007. Underwriting results from 2007 to 2011 were unfavorable. The continued stock market and high losses pushed the combined ratio to 105.2 in 2008 and 108.2 in 2011. While investment income offset the underwriting losses, net income and surplus declined in 2011 as the market began to harden. Investment returns: would you sell insurance if for every dollar you collected in premiums, you expected to pay 78% in losses and 30 cents in expenses? That payout rate would lead to a loss of 8 cents per dollar or premiums collected. Property and casualty insurance companies can and often do sell coverages at an expected loss, hoping to offset underwriting losses with investment income. In reality, insurance companies are in two businesses: underwriting risk and investment premiums. If insurance expect favorable investment results, they can see or sell their insurance coverages at a lower premium rates, hoping to offset underwriting losses with investment income. This practice is known as cash flow underwriting. During the period from 1980 to date, the annual combined ratio has rarely been below 100. Insurers frequently lost money on their underwriting activities and relied on investment income to offset underwriting losses. After the total rate of return on invested asset fell to 2.2% in 2002, the rate of return increased to 8.3% in 2003, followed by 4 years of returns in the 5.2% to 6.7% rating. Given the increase in funds available for investment generated by increased underwriting profits, net investment income was $50.1 billion in 2005, $53.1 billion in 2006, and $58.1 billion in 2007. Net investment income was lower in the next 4 years, reaching a low of $49.9 billion in 2010 and $51.4 billion in 2011. The recent low interest rate environment made it difficult for insurers to find favorable yields on fixed income securities. Sources of underwriting risk, wrong risk selections, inaccurate premiums pricing, high claim frequency, catastrophe losses, flood, earthquake, pandemics, fraudulent claims, adverse selections, moral hazards, impact of underwriting risk, financial losses, higher claim ratio, reduced profitability, solvency problems, regulatory interventions, reputation damage, management of underwriting risk, proper risk selections, underwriting policy, detailed proposal forms, medical examinations, life and health insurance, risk classifications, acceptance or rejection of risk proposals, scientific premium pricing, actuarial analysis, use of mortality, morbidity tables, risk-based pricing, diversification of risk pool, large number of policyholders, different geographical areas, different types of policies, reinsurance, transfer part of risk to reinsurers, reduces exposure to catastrophic losses, types, proportional reinsurance, non-proportional reinsurance, policy conditions and limits, deductibles, co-insurance, exclusions, some insurer limits, loss preventions and control, safety inspections, risk surveys, awareness programs, claims management, fraud detections, efficient claim settlement, claim audits. Example, health insurers charging higher premium for high risk patients, property insurer using reinsurance for earthquake risk, management of investment risk, meaning of investment risk. Investment risk refers to possibility of loss due to market fluctuations, interest rate changes, credit defaults, liquidity problems, poor investment decisions. Insurance companies invest premium funds to generate returns to meet future claims. Investment risk management is crucial for insurers because they must balance policyholder obligations with investment returns. Insurers collect premiums today, put but pay claims in the future. So their investment portfolios must be managed carefully to ensure solvency, profitability, and regulatory compliances. Understanding investment risk, market risk, losses due to fluctuations in equity, bond, or commodity prices, credit risk, risk of default by issuers of bonds or counterparties, liquidity risk, inability to sell assets quickly without significant loss, interest rate risk means impact of changing rate on fixed income, securities and liabilities, currency risk, exposure to foreign exchange fluctuations, and inflation risk, erosion of real value returns. What are the objective of investment risk management? Insurers asset liability matching to meet claims obligations, maintain capital adequacy under solvency regulations. For example, solvency to risk-based capital, optimize risk-return trade-off while preserving financial stability, support long-term growth and shareholder value. Strategies for managing investment risk, diversification, it spread investment across asset classes, sectors, and geographies. Asset liability management (ALM). It align investment maturities with expected claim payouts. Duration matching. Match bond portfolio duration with liability duration to reduce interest rate risk. Reinsurance and hedging, use derivatives, option swaps, future to hedge against market volatility. Credit analysis, conduct rigorous due diligence on issuers and counterparties. Liquidity planning, maintain liquid reserve for unexpected claims. Cash value life insurance is a superb product if you need lifetime protections. It is also sold as saving or investment vehicle. However, you should be cautious in purchasing a whole life policy primarily as an investment because the policy has cash values and provide other advantages. Alleged investment advantages of cash value life insurance include forced saving, safety of principal, favorable income tax treatment, protection against creditors, and a reasonable rate of return. Despite these advantages, however, a cash values life insurance has two major limitations as an appealing investment. The effective rate of return on the cash value is not disclosed to policyholders, and the loading for expenses when compared to competing investment in relatively high. The annual total return, dividends, and capital gains on mutual funds and individual stock is readily available to investors. However, this is not true for cash value for life insurance. The problem is that part of the premium pays for the cost of the insurance protections, sales expenses, and administrative expenses, whereas the remainder can be allocated to the cash value. Various techniques such as the Linton yield and yearly rate of return method developed by Professor Joseph Bell are available to estimate the rate of return on the cash value after deducting the cost of insurance. However, most policyholders are not aware of these methods and how they can be used. Moreover, the life insurance industry has consistently opposed legislations that would require disclosure of the true effective annual rate of return on a cash value policy. Some policies, such as universal life insurance, quote a current rate that is credited to the policy, such as 4 or 5%. But this is gross rate and does not reflect the true net rate of return after deducting the cost of insurance and other policy expenses. Is the annual rate of return on a cash value reasonable? The Consumer Federation of America, that is CFA, has analyzed thousands of cash value policies for consumers and has issued several reports. One yearly study of 57 cash value policies showed following year of policy held an average annual rate of return of 5 years. Rate of return is minus 14.5% of 10-year policy returns 2.3% of 15-year policy returns 5.1% of 20-year policy returns 6.1%. The annual returns are negative during the early years because of relatively high first year acquisition expenses and other continuing policy expenses. Moreover, because interest rates have declined sharply in recent years, the returns showdown would be substantially lower today. However, the figure shows that the annual rate of return can be considered reasonable only if you are willing to hold the policy for at least 20 years. You will lose a considerable amount of money if you surrender or let your policy lapse during the early years. Types of investment risk: market risk, interest rate risk, credit risk, liquidity risk, concentration risk, currency risk, impact of investment risk, reduction in investment income, asset value decline, inability to meet liability, solvency risk, regulatory penalties, management of investment risk, diversification of portfolio, equity, bonds, government securities, real estate, reduces concentration risk, asset liability matching, ALM, matching maturity and cash flows of assets with liabilities, investment policy, guidelines, regulatory investment limits, risk appetite defined by management, credit risk assessment, investing in a high rated securities, credit rating analysis, liquidity management, maintaining liquid assets, cash flows forecasting, use of hedging instruments, derivatives, future options, and swaps. We have already seen in our previous sessions. Stress testing and scenario analysis, market crash simulations, interest rate shock analysis, investment management by insurer, meaning investment management by insurers refers to the professional management of funds collected from policyholders to earn returns, ensure liquidity, maintain safety, match liability. It is a key function of insurance companies. Objective of investment management by insurers. First, safety of principal. Second, equity of claim payments. Third, profitability. Four, capital preservation. Five, compliance with regulations. Six, long-term growth. Principal insurance investment. Safety principles. Liquidity principles. Profitability principles. Diversification principles. Matching principles. Type of investments by insurers that are government securities, corporate bonds, equity shares, real estate, mutual funds, infrastructure projects. Investment processes of insurers, formulation of investment policy, assessment, portfolio constructions, monitoring and review, regulatory compliances, role of ALM committee, ALCO, monitor asset liability positions, decide investment strategy, manage liquidity, control interest rate risk, role of ERM in underwriting and investment risk, enterprise risk management, integrates underwriting risk and investment risk, link risk with capital and strategy, uses key risk indicators, KRIs, reports to top management, ensures holistic risk control, ERM ensures balance between risk, return and capital. Comparison given between underwriting risk and investment risk. Management of underwriting risk and investment risk is essential for the financial stability of insurance companies. Proper underwriting policies, scientific pricing, reinsurance diversification, and professional investment management help ensures reduce uncertainty and ensure solvency. Through enterprise research risk management, ERM, insurers can integrate these risks into unified framework and achieve sustainable growth. Thank you. Today's session is over.